Welcome back to 5 Good Questions. I'm your host, Jake Taylor. Our guest today is Jason Zweig. Jason is an investing and personal finance columnist for the Wall Street Journal, and previously he was a senior writer at Money Magazine. He's the editor of the revised edition of Benjamin Graham's The Intelligent Investor, the classic text that Warren Buffett has called by far the best book about investing ever written. Today we're going to be discussing his new book, The Devil's Financial Dictionary. Jason is one of the most thoughtful people in finance, so let's ask him 5 good questions. Welcome back to the show, everybody. My guest today is Jason Zweig, author of The Devil's Financial Dictionary. Hey, Jason, it's a real pleasure to chat with you today.
Thanks for having me, Jake.
So I have to confess that I've been really excited about this interview, given not only your work with the Wall Street Journal, but any association with the Intelligent Investor. I feel like I'm getting as close to Graham as I can get. So it's really special for me. I really appreciate you coming on.
Oh, my pleasure.
So let's jump right in. This book that you have, question number 1, the entire thing is really written kind of in a tongue-in-cheek nature, which makes it pretty funny. And so there's a bunch of these different definitions that you have in there of financial terms and kind of the double meanings of what they could be. What inspired you to write a book like this?
Well, I was redesigning my personal website, which is non-commercial, and it's really just where I post my articles, just as an archive. And my daughters were kidding me about how antiquated and lame it was, and I decided I needed to have some material on the website that would give people visiting there the sense that they were getting something a little new and different each time they came. And on the other hand, I'm just a ferocious believer that it's not my role to respond to short-term market movements. So I didn't want to do any sort of daily posting about what's going on in the financial markets. I didn't want to tell people, here's the action you need to take today. I just wanted to have something that was short and snappy and fun that would make people feel it was worth coming back.
And a little timeless.
Yeah. And so I was looking out the window, as I often do, and on one side of my window is a bookshelf, and on the other side of my window is another bookshelf. And both bookshelves had copies of The Devil's Dictionary by Ambrose Bierce, because it is one of my favorite books, and I happen to own 2 copies of it, because one of them became so worn that I had to get a new one in order to be able to keep reading it. And I said, well, of course, that's what I have to do. And so I started writing 1 entry, 2 entries a day, and the next thing I knew, I had, 100 of them or something. And the other thing I like to explain to people is, if economics is the dismal science, as Thomas Carlyle said, then investing is the abysmal art. It's it's not that it is boring, it's that people make it seem boring. And I really wanted to get across a sense of fun and also to find the humor that lurks inside this sort of self-seriousness that Wall Street has. So it began as just as a project for me to have fun. So,
well, it turned out into something that was pretty interesting. So, question number 2. I really enjoyed the entry on the term panic, and actually its roots in like the Greek god Pan.
Yeah.
And I was really impressed with the multiple parallels that existed there. Could you maybe explain that a little bit?
Yeah, sure. What I might do, Jake, is just read a couple parts of the definition. So the way this book works, certainly for our younger audience who think of dictionaries as things that exist only online, this is a classic dictionary in which I define the term, I give the part of speech, and then I give the full definition. So this one goes: panic, noun and verb, contagious fear that sweeps across a crowd, a market, or a planet, frightening multitudes of people into selling and leaving the rest wondering whether they should. The word derives from the god Pan, who haunted the pastures and wild places of ancient Greece. in the form of a grinning but ugly man with the horns, ears, and hairy legs of a goat. Pan was the god of herds and flocks, serenading them with his pipes. And so what I go on to explain in the definition is that in Greek mythology, Pan was often portrayed as this kind of prankster who would burst out on a sunny day in pleasant surroundings and just scare the daylights out of people. And of course, the word panic retains that connotation today. But there's some other interesting aspects as well, which is that Pan was also the god of fertility. And if you think about what a market panic really accomplishes, it destroys, and it essentially takes all the raw material in the market and turns it into fertilizer, right?
That's a nice way of saying it.
by destroying market prices, it creates value for the future. It creates future fertility. And the other interesting aspect is that Pan was closely associated with Bacchus or Dionysus, the god of alcohol, and he was usually portrayed lugging around a wineskin, a bag made out of goat fur that he used to store his wine. And there are very ancient connections between alcohol and the brokerage industry that I talk about in some of the other definitions.
So question number 3, I like to imagine these sort of two intersecting continuums. And so let's say like on one side you have a very like sort of be the casino, and maybe best example would be Joel Greenblatt's magic formula. You don't know where the returns are going to come from, but you just know that you have positive expected outcome bets. And then on the other side of that continuum, you have maybe more like Seth Klarman, or I should say maybe more like early Munger's fund, where it was like 4 positioned, well-researched, highly concentrated. And then on the other spectrum, maybe up and down, you have, or continuum, I should say, on the top, you have sort of like an all-weather approach that maybe Ray Dalio might best represent, where you're constantly rebalancing and you're just trying to stay fully allocated. And then on the other end of that would be more like Seth Klarman, where you hold a lot of cash, you're very opportunistic. What quadrant would you put yourself in as far as what makes the most sense to you or is the most appealing to you? And maybe what are your thoughts on that?
Yeah, well, if our audience can visualize it, I think I'd be in the northwest quadrant, but maybe I, because it's not so visual, I'll try to explain a little better. But I wouldn't be completely in that quadrant. I think for people who don't live hand to mouth, it's extraordinarily important always to have more cash in your portfolio than might even make sense in financial theory. I mean, cash is the raw material of opportunity. And, Ben Graham wrote a wonderful article for Forbes in the summer of 1932, in which he said, I think I have this more or less memorized, those with the enterprise lack the money, and those with the money lack the enterprise to buy stocks when stocks are cheap. And I've often paraphrased this from a modern audience to mean you have to have both cash and courage if you're going to buy at the most opportune times, at those moments of maximum pessimism that John Templeton talked about. Mm-hmm. So I think it's very important always to have boatloads of cash if you don't need it to fund your living expenses. But I also think it's extremely important to be maximally diversified. And if I were a more active investor, as I once was, and as I no longer can be because of my role at the Wall Street Journal, where we're not really allowed to trade, I would combine maximum diversification with selective concentration and a very high cash balance. Because I think that's the best way an investor can add value.
So what would that look like then? Just maybe a little bit more specifics.
Well, I think it would look like a portfolio consisting primarily of something like a total stock market index fund, with maybe at least 20% cash on the side, and then a handful of concentrated positions in deep value stocks, or maybe selected markets or sectors that had been particularly beaten up. But as I mentioned, this is somewhat hypothetical because
Sure.
because I as a Wall Street Journal employee, I'm not allowed to make trades. So
Yeah.
Yeah.
So question number four. One of the things I found surprising to be reminded of was how much of the terminology that comes from Wall Street is really derived from gambling parlance. Whether it's you're making a bet or you're all in on something, or a blue chip stock. These are all gambling terms that were sort of hijacked by Wall Street. Do you believe that the markets are kind of legalized gambling in a lot of ways, or kind of large casinos, or do you think they actually serve the purpose of allocating capital like we'd hopefully think that they did?
Well, I guess the answer is yes and yes.
Yeah.
Jake. I think it's both. I think, as is always the case, we can go back to Graham and remember that so much of his writing should remind us that investing is a head game. Just the way elite professional athletes always talk about how what they do is a head game. Tennis is the person who wins a professional tennis match is the one who makes the fewest unforced errors. Mm-hmm. You look at football, people who avoid turnovers and penalties are on average going to be a lot more likely to win more games. And so much of that has to do with self-control, because those unforced errors tend to come from our own temperamental weaknesses, our own inability to play the game that we can excel at. And instead we end up playing somebody else's game. And for example, if you look at the political debates, Trump has really forced all the other candidates to play his game instead of theirs. And he's better at his game than they are. So he's winning. Who knows how it'll turn out. But so if you play Wall Street's game on Wall Street's terms, it is a casino, and the house wins. But if you play the game on your own terms, whatever they might be, you could be a deep value investor, you could be a long horizon growth investor, you could be doing some kind of algorithmic trading that you've figured out how to make work. If you play your game, then it's no longer it doesn't have to be a casino.
I think that makes a lot of sense. Question? Do you have a follow-up?
Yeah, I was just going to say, there's a wonderful line from the great writer Adam Smith, not the economist, but the
pseudonym.
Yes, the market commentator whose real name was Jerry Goodman, whom I'm proud to say was a friend of mine. He died a couple of years ago, but in his book, The Money Game, that was published in 1968. He has one of the best lines ever written about investing, where he says, if you don't know who you are, this is an expensive place to find out. And of course, by this, he means Wall Street. And it really is one of the best lines ever written, because if you don't know who you are, then you are playing in a casino and you are a chump.
Yeah, it kind of reminds me of Warren Buffett said it, but a lot of people have too, about, you sit down at the poker table and you don't know who the patsy is, then it's you, right? So
right.
Similar. So question number 5, what's the one quality that you would say that people should cultivate to become a successful investor?
Well, the great investment consultant Charlie Ellis gave a speech many, many, many years ago in Toronto, where he talked about the 3 ways to succeed as an investor. And I think he called them physical, I think he called the first one physical. And the idea was you just outwork everybody else. You get in, you're the first one to turn the lights on in the morning, you're the last one to leave at night. You read more research than anybody else, you analyze more companies than anyone else can. It's physically it's physically very demanding, and some people can succeed at it. The second way he pointed out was intellectual superiority, where you just are smarter than everybody else. You're born Warren Buffett or Charlie Munger or Seth Klarman or any number of other people we could name, although we couldn't name many. And so there's physical, there's intellectual, and then there's emotional. And the emotional way isn't easy either, but I think it's more accessible for people. And it's also, you don't have a fixed endowment. I mean, you can cultivate it, you can develop it. And so if you have that emotional way to succeed, what that really means is that you're inversely emotional. You turn other people's emotions inside out. Getting back to Buffett, it's his classic line about being fearful when others are greedy and greedy when they're fearful. It's much easier said than done, but I think people can get better at it. And I think that the key is self-control. And I think the more self-control people can cultivate in all aspects of their lives, the better investors they will be. And the ability to defer gratification, to foster patience in your own personality is, I think, really an underappreciated attribute. And while there are great investors who are not sort of physically superior to everybody else, they don't turn over every rock. And there are some who might not even be intellectually superior. They just have really good process. Mm-hmm. I can't think of anybody who's a great investor who doesn't have unusual self-control. And that's the quality I think is really underappreciated.
And the good news is that we can build that ourselves. It's much like a muscle. At least my understanding of the research is that your self-control is a muscle that if you work it out, you get more of it.
Yeah, the research on there's a ton of research on that. It's there appears to be a pretty strong consensus in the scientific community that we can get better at it. The earlier you start, the better your results are likely to be.
So you don't eat that first marshmallow that's offered to you? Is that
when you're 4 years old?
Yeah.
But you can get better at it, and it's a discipline that requires constant exercise. And I think even into people's 50s and 60s and beyond, they can get better at it. And there's a wonderful anecdote about Warren Buffett, by the way, which I heard originally from Walter Schloss. He was golfing with some friends one day, and one of them offered him a bet and said, it was an odd bet. It was something like, let's bet $1 that I can't get a hole in one, but if I do, you have to pay me $1 million. And Buffett just shook his head, and the person said, well, you're going to be $1 richer. Almost certainly. What's the problem? And Buffett said, well, if you can't be disciplined in the small things, you can't be disciplined in the big ones. And the point is that he's always using that muscle, even when he's off duty, and he's always trying to make it stronger. And there's a real lesson in that for everybody, I think.
Yeah, that's a great story. I've heard that one before, and it always impresses me. In fact, one of the things, like, I almost wonder if he doesn't have some kind of compulsion towards capital allocation being like fully maximized. And for instance, he had that famous hedge fund bet where he took the S&P and the fund of funds, were racing against him, and he at one point actually got out of the bet, basically like put a guarantee on it. in order to, he bought like more Berkshire with it instead, because it wasn't a proper allocation the way that it was set up. So to think that you had to go and like talk to them, and it would probably be a pain in the butt to change this around, but like he just couldn't sit with the money not in the right place at that time.
Yeah. This is a good moment, Jake, for me to just remind our audience of just how hard what we're talking about really is. I'm going to read two really quick definitions.
Yeah.
Long-term, adjective. On Wall Street, a phrase used to describe a period that begins approximately 30 seconds from now and ends at most a few weeks from now. And then I'll read short-term, which is short-term, adjective. On Wall Street, 30 seconds or less, as opposed to long-term, which is 30 seconds or more. And it's really, I think it's very important for people to realize that the reason self-control is so valuable to you as an investor is because it's really a precious commodity. It's probably the rarest commodity in the entire financial industry. And that's why it's valuable. And that's why people who cultivate it and really do develop it can succeed. It's also why the people who don't have it but think they do end up driving themselves onto the rocks. And maybe I can read one more definition. It's also pretty quick.
Yeah, please do.
Which is, of course, maybe the most important definition of all. Risk, noun. The chance that you don't know what you're doing when you think you do. The prerequisite for losing more money in a shorter period of time than you could ever have imagined possible. Risk can be formally defined as the odds of an adverse or undesirable outcome. When the forecast is for an 80% chance of sunshine, for example, then the risk of rain is 20%. Or as the extent to which extreme outcomes differ from the average. It has been philosophically defined by finance professor Elroy Dimson of London Business School this way: risk means more things can happen than will happen. In the end, risk is the gap between what investors think they know and what they end up learning about their investments, about the financial markets, and about themselves. And I think that's people who can understand that. If people understand that definition, then any money they spend on the book might be well spent.
Totally. So the bonus question we always ask everybody, and with somebody who reads as much as I'm pretty sure that you do, I'm really curious to hear what you have as a book recommendation for us.
Yeah, well, there is a book that I love that I often recommend that's wonderful because it's accessible to every audience, no matter how sophisticated or could just be somebody starting out. And it's also a book you can read on a single train ride or at the beach in a morning or an afternoon. It's called How to Lie with Statistics by a man named Darrell Huff, Huff. He originally wrote it, I think, in the 1950s. It has never gone out of print. It's illustrated with wonderful cartoons. And it is a great way to start yourself on the path toward becoming a critical thinker if you aren't there yet, or to remind yourself, if you already are, of the basic principles you need to stick to be an effective critical thinker.
Well, Jason, that's a fantastic recommendation. I actually haven't read that yet, so I'm going to pick up a copy for myself. And it was so good talking to you, and I loved hearing all of your different insights. I mean, I knew that as much as you've had to write over the years, you knew that there was going to be a lot of good stuff in this one, so I really appreciate it.
Yeah, Jake, my pleasure. Thanks for having me.
Absolutely. All right, take care.
Okie doke, thanks.